Good morning, everybody. My name is Mark Rubinson, and I'm one of the partners here at Gravita. I sometimes get involved in presenting our webinars, but today I'm simply introducing my colleague and our legendary tax consultant, Tim Palmer, who is going to talk to you about tax planning for owner-managed businesses. Tim's been with us for many, many years, and he's an integral part of our tax team. And I think it's safe to say he's the UK's top tax lecturer. Welcome again to many of you who've previously attended our webinars, and a very, very warm welcome to those of you who are joining for the very first time. I believe we're expecting a record attendance today, over 400 people, which is amazing. A quick introduction to Gravita for those of you who are joining for the very first time. We are a full service firm of accountants who, through our amazing team of over 400 people, help ambitious and growing businesses to plan better through our accountancy, tax, audit, outsourcing and advisory services. We've got a particular emphasis on owner-managed businesses, and our aim is to be the UK's #1 specialists with owner-managed businesses. We are on an extremely exciting growth journey, and just last week we welcomed our new Southwest team to Gravita. We are thrilled to now have offices in London, Oxford, Bristol, Exeter and Essex, and continue to grow to support our clients wherever they are. Please home in on our website. We've got exciting tax blogs, and we've got some very interesting webinars coming up, including on the 3rd of March, Public Service Pensions and Urgent Tax and Pensions Update, 11th March, FRS 102 changes, and 27th March, Benefits in Kind, an update and how to plan for those changes. Without any further ado, over to my colleague, Tim Palmer.
Thank you very much, Mark. Right, good morning, everyone. Mark, you and I go back a long, long way. I think first time I met you when I was lecturing for past training, that may have been in the early 1990s. But Mark and I go back a long way. I'm a tax consultant with Gravita and I lecture around the UK. This is a very practical session this morning. You should really have a set of notes in front of you. If you've got any problems, Jay will sort you out with those, but I'm sure you have. You need a set of my notes in front of you. Every time that I do a webinar presentation, and I do probably 2 or 3 every week, I always ask the audience to have my notes in front of them so they can mark them up with my extra comments the whole way through. And if you look at the screen, if you've got any queries this morning, reach out to us. If you need tax consultancy advice, there's the email address there, hello@gravita.com, and our team can help you. Okay, now what I'm going to do this morning, there's a lot to cram in just under 1 hour, but what I'm going to do, tax planning for the owner-managed business, I'm going to give you a 12-point guide. A dozen areas. I mean, I could do 20 quite comfortably if this was a longer lecture, but it isn't. This is 1 hour giving you a concise 12-point guide on the major things that affect owner-managed businesses, which Gravita really specialise in, as Mark said. So the first one, and perhaps it's the nastiest, and it's the one that perhaps I'm not looking forward to mentioning, National Insurance. Oh my goodness me, this is going up big time, isn't it? We're on page 2 of the notes now, so turn to the notes and you'll see everything I'm saying. I'm following the notes very closely this morning. National Insurance contributions, horrific. On the 6th of April, this goes up to 15% for employers, NIC. Do you know, it's a shame actually, because I've got so used to quoting 13.8%. And in just over a month's time, I'll never have to use 13.8% again. It's ingrained in my brain. But National Insurance goes up to 15% for employers. This is a big hike. I don't care what anybody says. And if you're an owner-managed business, I mean, I speak to my relatives, you know, who've got businesses, big businesses, some of them, you know, Barthender's family, the husbands have got big businesses. And I speak to them and they say, this is killing us. And a lot of people are doing planning and have been probably since Christmas time in readiness for this employer's NIC increasing to 15%. And obviously, you know, if you look at the threshold, that's going down. So the 15% will be payable earlier and more frequently and quicker from 6th of April. So what are people doing, right? You will need a pen ready today to jot down the extra things that I'm saying the whole way through. But what people are doing, I think they're definitely keener to engage self-employed workers. There's nothing wrong with this, in my opinion. I'm just going to give my thoughts today. You know, somebody very involved in tax, it's my life. Tax and Tottenham, but I don't want to talk about Tottenham today because I'm happy, and talking about Tottenham would make me sad. But basically, yeah, people are coming up to me at lectures last week and saying, we've got a client. They engage 20 building subcontractors. Can you get involved? And can we engage these subbies on a self-employed basis? Well, it depends on their circumstances, how the engagement. But the key thing is, for me to do something like that as a tax consultant, I want to get in before the engagement started. And I want to educate the contractor on how to engage these people on a self-employed basis, and it can be done. But there's a lot of other factors, you know, a lot of other factors depending on if they've got other clients, all sorts of things. But I think people do need, quite legitimately, to be proactive now, because you haven't got much time left, to try and mitigate the impact of the 15% employers NIC. That's for employers. Now, moving on, for employees, they've got quite a good position, personally, I think, because surprisingly, you know, there was rumours, Rachel Reeves has not extended Class 1A national insurance on benefits to employees. Before the budget, there was huge rumours that employees and directors were going to have personal national insurance on their company cars and benefits. Never happened. So I actually think employers are taking the hit for the national insurance and the employees are not. And their rate is 8%. That was reduced previously, and the surcharge still stays at 2%. So employees have got as good a position as they could possibly have hoped for, I think. And if you turn over to page 3, self-employed people as well, I think their national insurance, the class 4 position, 6%, again with the 2% surcharge, is okay. So it's employers who need to consider, you know, engagers. Can we do some planning? Can we engage people on a self-employed basis? You want to draw up contracts, we could help you review the contracts. But I think the work needs to be done before the engagement starts, well before the engagement starts. Now, if I can just tell you something, I'm not going to hold back this morning. I think you can sense that already. But if you go to page 3, what was it? 2 years ago, I think now, an accountant said to me, we got problems with a subby client, a building client. Can you see him? And I didn't know what those problems were, but they arranged for me to see the building subby. And he said to me, Mr. Palmer, you've come highly recommended. I said, thank you, that's great. And he said to me, HMRC are alleging I'm not self-employed. And I said, well, who are HMRC alleging is employing you then? This is shades of Regan from the Sweeney, if you can remember that. I'm showing my age. I need a name. And he gave me the name. If I can just, any names that I'm mentioning today are purely hypothetical. Bovit. And I said, right, your relationship with Bovit, go down the notes with me, keep up with me today. A bit of work for you today, really. And I said to him, right, okay, does Bovit control you? And he said, no, they give me the work. I'm an experienced builder. I do it. They come at the end. They don't control me. And I said, do they have to give you work each week or each month? And he said, no, I've got lots of other clients. Sometimes they give me work. I can't do it. He said, I like to go abroad with my wife. And, you know, we work hard, but I like to relax a bit. I could turn the work down. I thought, brilliant. There's no mutuality of obligations. And I said, have you got a substitute? And he said, yeah, it's in my contract. And I started to look at the contract. We'll call this subby Alan. And I said to Alan, your substitute, who chose it? And he said, well, I did. It's mine. And I said, is he at the same technical level as you? And Alan said, yeah, he is. And I said, have you ever used him? And Alan said, yeah, a few times. I said, right, well, when you've used him, who bills who? And he said, well, it's my contract. I bill Bovit and the substitute bills me. I thought, brilliant. You know, you're doing everything correct. And the fourth thing I said to him, as all this is going down the order of the notes, the fourth thing I said to him is, do you pay your own public liability insurance? And he said, of course I do. It's my business. I've been paying it for 20, 30 years. I stopped there. And I said, well, there's no doubt in my mind that you're genuinely self-employed. I asked him a few other things, but he was. We took the case over, we won. So, you know, it can be done. And I'm sure a lot of people are doing a lot more planning in this area prior to 6th of April, when the employer's NIC does go up to 15%. If you look at the screen, yeah, I'm going to put in extra slides today because I really want to give my opinion on things, if you don't mind. And these are the areas where HMRC are currently challenging certain professions, certain trades on the area of employed versus self-employed. And if you don't mind me saying so, if you look at the screen, I've got 2 slides about this. I'd say the worst one that I'm experiencing at the moment and seeing, you know, from people coming up to me at lectures and things, is dentists. Now, for some reason, HMRC have got their teeth into dentists. Did you get that? Teeth into dentists? They have. And they're arguing that a lot of dental associates are not self-employed. And in fact, you want to jot these points down, the extra points. And I think Gravita are taping this, so you can always, after the webinar, you can always see a recording of it. This is why you need to go to Gravita's website so frequently. But dental associates, there must be a question mark on some of them. Are they genuinely self-employed? And something interesting, HMRC changed their manual a little while back, and they're getting more aggressive on dental associates. They're also challenging the status of some dental nurses and hygienists. Now, with hygienists, I think you can do quite a lot of planning there. And if the hygienist comes in 1 or 2 days a week and she's wearing a different uniform to the rest of the people at the dental practice, and it's pretty obvious that she's different from them and self-employed, I think you could do an engagement and a contract. The contract has got to tell the truth and do the planning. And, you know, nobody controls that hygienist. They just leave her to do the work. Ideally, she doesn't get paid if a client doesn't turn up. You know, you could get the engagement and really engage her in a self-employed way. It's easy to do. Gravita could help, you know, everyone with that, accountants and clients in practice. So but this is a big attack. And in actual fact, I don't know if I got it on the screen. If we broaden this, we saw an attack fairly recently on an equine dentist, a lady, a charming lady, who cleans the teeth of horses. Have I got it there? Yeah, there you go, on the extra slide. So this is an area that needs a bit of work, and ideally you want to do all the work prior to the engagement starting, and we could really help you with this. Now, there's one leading case that, you know, I did say I'd add in extra things today. There's one leading case that you would do well to refer to. Castle Construction of Chesterfield, jot that name down, versus HMRC. This, to me, little extras the whole way through this morning, this to me is the most important and the best ever case I've ever seen on employed versus self-employed. Castle Construction engaged 320 builders. That's a lot. But they were clever, and they engaged them in a self-employed way, and they won. And they didn't have to pay a penny of extra pay as you earn because these guys were self-employed. Have a look at that. If you want a case how to engage a self-employed builder, Castle Construction Chesterfield's the best one. Right, now, the contract, and we could review a contract for you, has got to tell the truth. It's got to represent the reality of the position, but that's important. There was a case called Narridge, and in the Narridge case, the judge said, if ever there's a dispute on employed versus self-employed, the starting point is the contract. And a few years ago, I was in a meeting with HMRC, and we had a builder, me and the builder, The builder was very nervous. I could use an expression, but Gravita won't allow me to do that, and I don't think I should anyway. But he was nervous, and HMRC had loads of people in this meeting. It was like tons of them, and they started asking him as soon as the meeting started about did he attend the company's Christmas party, and I said, excuse me, we'll deal with that at the end. That's trivial. Marriage. And the HMRC know marriage. It's like a swear word, and they know that if the accountant, can I put it in football terms, can play, he will quote marriage, and that forces the HMRC to look at the contract as the first thing if you're in a meeting, or if you can do it through correspondence. And the contract's got to tell the truth. But if the contract proves that there's no control, no mutuality, you've got a substitute, and the individual's paying his own public liability insurance, the 4 points I raised earlier, you win. So have a look at all of that. Now, my opinion about IR35, maybe it's different to other people, but I did a lecture recently in London, and all these accountants were coming up to me and saying, oh, you want to shy away from personal service companies. I don't agree. I think you can still use them, but you need good contracts, and the engagement has got to be geared from the start to prove that if Sebastian was working directly for the client, he'd be genuinely self-employed. What's wrong in doing that then? You can defeat R35 if everybody's on the same page, good contract, and everything is genuine. And if Sebastian didn't have the protection of his company, he would be genuinely self-employed. It's defeatable. I deal a lot with IR35 in practice, and I'll tell you one couple of things that annoy me, and you could jot them down. There's a little extra. Number one, I think a lot of clients, big companies who have to decide about IR35 now, are defeatist, and they sort of think, well, if in doubt, we'll apply IR35. They shouldn't. So I think really, if you are the accountant, Sebastian, who's got a big contract with a client, I think you need to get everybody on board prior to him signing that contract and just say, right, can we work in this way? The contract's going to reflect it. And can we have your agreement, Mr. Client, that it's outside IR35? We don't want any nasty shocks. We don't want you deducting IR35. And the other thing, and I'm not going to hold back and I'm going to mention this here, the other thing that I don't like is where the client doesn't really tell anyone, the ultimate client, and they apply IR35, and then they suddenly realize that they've got to pay employers' national insurance, and they deduct the employer's national insurance from the fees that Sebastian's charging. I think that's unlawful, but it does happen, and unfortunately it happens in the public sector as well. So again, if you've got R35 issues, but the main thing is to try and get it all set up prior to the engagement starting. But we could help you with that. Right, let's move on, Ashay. Let's just move on. Now, if you go to the notes and go to page 4, one of the biggest changes on the horizon is this one. And you might want to note from 6th of April 2026, the P11D form is scrapped. So you could write that in on the top of page 4. The P11D form is scrapped from 6th of April 2026. This is going to be a real shame. Is it a shame? I don't know. Well, it's going to be sentimental because the P11D form is scrapped, and every employer in the UK will have to payroll their benefits. If you give company cars as an employer from 6th of April 2026, you'll have to put them through the payroll. There's no way out of this. It's now going to be compulsory in just over a year's time. So the P11D form is scrapped, and payrolling for every employer benefits comes in on the 6th of April 2026. Now, Mark and I go back a long way, and unfortunately, I go back longer than him because I'm older than him. But I've been doing P11D forms forever. And it'll seem very strange when I complete my last P11D form for 25-26. I wrote an article about this actually in Taxation Magazine almost 10 years ago. And I predicted what would happen. If you go on eBay, you can buy signed copies of that article. Can I just say that was a joke because somebody tried to a while ago and I had problems. So that was a joke. Can I just make it clear? But yeah, I did this article on payrolling benefits, and I said, well, this is the future. But the article was almost 10 years ago, and it will be 10 years ago when it comes in next year. And I said, this is a huge change, but the P11D form is antiquated and it should be scrapped. It took them 10 years to get round to doing what I suggested, but they have. When you complete your last P11D form for 25-26, you want to take a copy of it and you want to show your grandchildren in years to come and say to them, this was what I did in my day. And your grandchildren will become accountants. Mine will be. Amy, my daughter's already planned it. She wants me to babysit for her children when they're very young and teach them tax with my gregarious and enthusiasm. She wants her, particularly her grandson, to be an accountant specializing in tax. That's my task for my retirement. But anyway, the P11D form in 25-26, this is your last one, and you want to take a copy of it and show your grandchildren what you did in your day. And also, I understand that the government is thinking of having some sort of memorial to mark the passing of the P11D form. Right, okay. Anyway, what's going to happen? Well, you're going to have to payroll all benefits in kind, apart from a couple, and the couple are on page 4. So you've got to adapt to this. It's only just a year away. You know, you really do need, this is one of the biggest changes in tax. Our Gravita payroll team could help you get ready for the compulsory payrolling of benefits in kind. We could help you. It's a major change. And if you're not really geared up for it, will you be able to cope for it? You know, because you're going to have to start planning for it. I would have thought January next year, because suddenly you've got to put through company cars through the payroll. Do you know how to do it? Are you geared up? Are you going to calculate it correctly? Are you going to put it through every month correctly? This is an issue that our team could help you with. Right. If I was doing this lecture, this webinar as a lecture, I'd pick on somebody in the audience and I'd say, what else is going to happen on 6th of April 2026? What's the major change? And probably a delegate would get it correct and they would say Making Tax Digital comes in on the 6th of April 2026. It does. And so Making Tax Digital comes in on the 6th of April 2026 as well. Two very important things. Maybe that's for another day. Maybe Gravita will do another webinar on that in due course. I'm sure they will. But you need to be geared up for that as well. And I'll tell you one thing, you know, keep up with me on all my comments this morning. I'll tell you one thing that I think accountants are not appreciating. Making Tax Digital for income tax has a huge impact on individual landlords, because it's really traders and business people, sole traders and landlords with turnover, not profits, turnover of greater than £50,000 that will have to comply with Making Tax Digital for income tax self-assessment in just over a year's time. And they'll have to do the quarterly reporting, and it's quite onerous. And again, I honestly think you need to start preparing for that quite soon. Anyway, that's for another time, another day. Right, go to page 5. This is a very important planning point, I think, for individuals and their personal national insurance contributions. When I was with one of my relatives recently on Barthners, my wife's side, they always nab me at family dues. One of my Barthners, I call it mine because I'm so close to all her family. One of the nephews the wife is expecting a baby very, very shortly. And there's been a big do. The whole of the do, people took it in turns to come up to me wanting free tax advice. Anyway, one of them said to me, what's this I hear about national insurance contributions and the gaps? And I said, well, do you think you've got any gaps in your national insurance history paying? And two of them came up to me. I'll do the lady. And she said to me, yeah, I went away for a while and I stopped paying national insurance for a while, temporarily. And I said, well, you need to sort it out. And she said, what do I do? Page 5 of your notes, you should tell your clients about page 5. And I said, well, you've got to act quickly here, because if you go to the online tool that very kindly HMRC have produced, you can key in your details and your gaps will come up, and it will come up and show you how much you've got to pay to bring your national insurance contributions up to date. And she did. And she said, is there any rush? And I said, yes, there is. If you make the extra contributions now, so long as you make them by 5th of April, you can go back 19 years. But if you're lazy and you don't make the extra contributions and you make them after the 6th of April, you can only go back 6 years. So, you know, you really, if you're an accountant watching this, and I know there's over 400 people watching this today, you've got to tell your clients, this is last chance saloon. You've got to act very quickly. And you've got to tell your clients, particularly the self-employed clients, I would have thought, particularly people who've, you know, been currently employed, might have had gaps, also for various reasons. At the moment, you can go back to 2006, approximately 19 years, pay the extra contributions, which I'll prove to you in a minute are very useful to do. But after 6th of April, I don't know why, you can only go back 6 years. So it's something you really want to have a look at. Read, I'm going to have to move on and speed up because we've got so much to get through yet. But you want to have a look at this, and it really, really is worth making these extra contributions, right? You need 35 years of national insurance contributions to get your full state pension. It's going to cost you 825 roughly a year if you've got a gap year. But then once the pension starts, you know, that'll be worth £330 a year, and you only need a few years to have repaid that many times over. It really is worth doing. And I tell you what, I spoke to, because I'm very into finance away from my tax, and I spoke to a broker recently, and he said to me, if somebody was trying to get an annuity, a pension, off their own back, ignoring the state, they'd have to take out an annuity of £260,000 to secure the equivalent, you know, annuity pension. So it's really worth doing, but you're going to have to act fast. Right, leave you to consider all of that. Right, we're going to move on a shade now because there is so much more to cover. Right, part 2. Capital gains tax didn't really go up really much at all in the October budget. All they did basically was they said, if you're a high basic rate taxpayer, you're now going to pay 18%. And if you're a higher rate taxpayer, you're going to pay 24%. In general terms, that's capital gains tax now from the 30th of October. But they did announce one important thing on business asset disposal relief that is called, was previously called entrepreneurs relief. And they said that we're keeping the 1 million, so a 1 million lifetime allowance. You can sell businesses cumulatively, and the gains up to 1 million in your lifetime will be, the tax will be 10%. But what they did, look at the screen, look at the bottom, page 6, the rates of capital gains tax on gains eligible for business asset disposal relief have been 10% for decades, but they're going up. So if you sell a business and you qualify for business asset disposal relief, at the moment you pay 10%, but from 6th of April it goes up to 14, and then the following 6th of April it goes up to 18, and you could write in, there are big rumours that she will announce very shortly that after 2026 it's going to go up even more and more. So a lot of people are thinking, wow, perhaps if we liquidate our company now, get capital distributions, and then this is our last chance before the 5th of April to pay 10% CGT, which it probably is. But there's a problem. If you go over the page to page 7, I'm getting all these accountants saying to me, we're going to liquidate our company and we're going to get the money out as capital distributions. We're going to beat the 14%, you know, the increase. There's a problem. And the problem is the targeted anti-avoidance rule, anti-avoidance legislation, the TAR. Right, what's all this about? Page 7, I hear you ask. Well, if you liquidate your company, right, and then you start the same trade up again, or a similar trade, within 2 years of the date of the last liquidation and distribution payment, the TAR could kick in. So you just want to jot down, this is very, very dangerous, and HMRC have stepped up their attacks on it. We've had consultancy requests on it. We've had accountants coming in saying, what's all this? Our client liquidated the company. They've started the same trade up again. And I say to them, well, didn't you come to my lectures? I've been talking about this for ages. And there's problems with it because some accountants don't know about the TAR and they don't warn their client. And you really need to warn them now because a lot of people are liquidating to get the money out for the last time at 10%. If you liquidate your company and then start the same trade or a very similar trade up again within 2 years of the last liquidation distribution payment, and the revenue can prove that you liquidated really to get the money out at 10% and to avoid a big income tax charge, what will the revenue do? They'll apply the TAR. And they'll go back to the liquidation and they'll tax the gains as income, and the top rate that they can charge is the normal rate on dividends, 39.35, i.e. 40%. So, you're multiplying your tax liability, or it goes up from 10 to 40, massive increase if you get caught by the TAR. Now, for the revenue to apply the TAR, they have to prove that 4 conditions apply. Go to your notes. Condition A, the individual had 5% of the company. I'm really, because I've got a lot to cover this morning, I'm really paraphrasing this, summarizing it. So yeah, he's got 5%. Normally that always applies. B, it's a close company, always applies. This is where it gets interesting. The individual's liquidated his company, but he started the same trade up again within 2 years of liquidating. And you want to turn over to page 8. He could start the same trade up again in one of 5 ways: sole trader, partnership company, LLP, or employee of a connected person. So you might have somebody liquidating now, getting the money out at 10% for the last time, but then they start the same trade up again as a sole trader or a partnership or another company, etc. The revenue then will be honed in on applying the TAR, but the revenue have still got to prove condition D, A, B, C, and D, last condition. Revenue got to prove it. It's reasonable to assume that the main purpose, or one of the main purposes of the winding up, is to avoid or reduce a charge to income tax. So what the revenue got to prove is that you liquidated to get the money at 10% to avoid income tax at almost 40. And I'll tell you what, in what I've seen from the revenue so far, they will always assume that you did that. Why did you liquidate and then start the same trade up again within 2 years? Surely the revenue will say you liquidated to get the money out at 10% to avoid higher rate income tax. Right, look at the screen. And I think if there's one slide you want to jot down from this morning, it's this one. To avoid the TAR, you need a commercial reason why you liquidated, or perhaps an exceptional reason. So to avoid the TAR, you've got to prove that your liquidation wasn't to avoid income tax. It was a commercial reason or an exceptional reason. I've been involved with the TAR a few times, and we won one case where there was an exceptional reason. I haven't got this in the notes, but you could just jot down the key points, but it's pretty obvious. Frank and his wife, Jill, they had a florist shop. Lovely. I went there. They were a lovely couple, and they were very successful with it. But then tragically, she got cancer, it was terminal. She became really ill, and he liquidated the company on the advice of the accountants, and Capital Distributions got the money at 10%, and he became her full-time carer. She died. It was so upsetting. Really, I don't want to talk about it now because I would get upset. And he couldn't cope with it. So to take his mind off, he opened another smaller florist quite a few miles away and started up a sole trader business to fill his days, really. HMRC attacked with the TAR. He successfully defended it, And he said, condition D doesn't apply. We liquidated the company so that I could become her full-time carer. We didn't liquidate to avoid income tax. And HMRC eventually accepted it. So can I just put up that previous slide? That's the key thing. To avoid the TAR, you will need a commercial reason or maybe an exceptional reason like the florists to avoid the TAR applying. All right, leave you to consider that, but you've got to warn your clients. It's really, really important that if they're liquidating now, which a lot of people will be, to avoid this hike in that Rachel Reeves has introduced on business asset disposal relief, if you start the same trade up again within 2 years, you could have big problems. So I'll leave you to consider that. And honestly, I'm not going to go through the figures now, but if it bites, you can have massive extra tax liabilities here. Now, Gravita's got a very experienced tax team, and we could help you and advise you in connection with the TAR and do planning with you. But that's something you're going to have to approach us with if you need the advice. Right, now I'm going to give you, for 2 minutes, a little extra. And a little extra that I'm going to give you, not in the notes today, but the owner, businesses and everything. A lot of people, this is not in the notes, but last night when I'm finishing planning for this course, I'm thinking, I think I should mention a few minutes on furnished holiday lettings. So if you've got a pen there, you might just want to jot down that furnished holiday lettings from 6th of April, little extra, in just over a month's time, is no longer a trading activity. You need to send circulars around to your clients, to send a global email and say to them, have you done all the planning that's necessary? And there is a lot of planning that they can do. I'm quite involved with this. Our team's involved with it. And the planning that they can do, you need to remember that furnished holiday lettings activity is currently regarded as a trade, but from 6th of April 2025, it becomes a normal rental activity, not a trade. So jot down, you can no longer do the following on the screen. And can I expand it? And if you've got a pen, you can note these things. At the moment, if you make profits from furnished holiday lettings, it's relevant earnings and it can support your pension contributions, but it won't be after 6th of April because it's no longer a trade. At the moment, I know somebody who's got a beautiful house in Mayfair that, it's not so much Mayfair, that's a bad example of furnished holiday lettings, Cornwall. My mum used to, when she was young growing up, she was born and lived in Devon before she met my dad. And thanks to her, I've got clients still in Devon, in Ilfracombe, from memory, Topsham, in Cornwall. And these guys have got furnished holiday lettings down there, and one in Bournemouth and another one in Bewley. And what they're doing now is, for the last time ever, really, they're doing massive refurbs that they are putting in terms of, they're putting in new kitchen equipment and getting cap allowances for the very last time. So you really do need to remind your clients that they've got until the 5th of April to incur all the expenditure and get your cap allowances. Because after 6th of April, there's no more cap allowances because it's no longer a trade. And the other thing to remember, if you have got losses on furnished holiday lettings, it's not a problem. In fact, it's good. It's not good you've got losses, but if you have, they've changed the rules, and this is the one bit that is tax planning that's beneficial. You can carry the furnished holiday lettings losses forward against all rental income, which you can't at the moment. So that's the one weird thing that's good. The other thing that a lot of people are doing at the moment is last minute capital gains tax planning on furnished holiday lettings, because if you sell the property, hopefully the business, you can get business asset disposal relief that we just looked at and pay capital gains tax at 10%. But that goes from the 6th of April. What some clients are doing is gifting the furnished ID lettings properties to their children. They're also claiming rollover relief. All of that stops on the 6th of April. We could help you with planning for that if you need some advice and help. Right, moving on to page 9, item 3. We've got 12, so I've got to speed up and get through all of it before I finish. Item 9, just remember a little thing in passing. Double cab pickup trucks. Currently, they're taxed as vans. But from 6th of April next year, if you buy a double cab pickup truck, you're a business, and you buy one from 6th of April 2025 onwards, they're going to be treated as cars. So that's going to be dreadful for benefits in kind in particular. I mean, I've got a friend who I work out with in the gym, and he has got his own building business, and he's got a beautiful double cab pickup truck. And he jokes with me about it. It's beautiful. It's a poser thing with him. And he comes up, bowling up, particularly in the summer, in this double cab pickup truck. I've never seen any cargo in the back, but he uses it privately. He's a director, obviously, an owner of his company. And the benefit in kind is it's a van. So if you look at your notes on page 10, his tax payable on the beautiful 50,000 pound double cab pickup truck is £2,000 odd, because it's a van. But you want to note that from 6th of April next year, it's treated, if you purchase one from the 6th of April, it's treated as a car, and the tax on that is going to be massively more, and I'll prove it in a moment. But there's a way around it. If you go to page 9, you want to star the middle of page 9, there are transitional rules. And if you buy the double cab pickup truck or order it or lease it before the 6th of April, it will continue to be treated as a van for tax until 5th of April 2029. Star the notes. Tell your clients if they're thinking of buying double cab pickup trucks, at the very least, they've got to order it and then purchase it before 6th of April. And then until 5th of April 2029, the transitional rules kick in and it's treated as a van, much lower tax, until 5th of April 2029. All of this is in the notes. So tell your clients if they're thinking of buying a double cab pickup truck and they're going to use it privately, in particular, the directors, got to buy it, order it before the 5th of April. And obviously the difference, if it's a van, which it will be if you do it before the 5th of April, and it will continue to be a van until 5th of April 2029, you pay £2,000. If you buy after 5th of April, it'll be treated as a car, and the tax, can you believe, is £13,000 if you're putting private fuel in. It's a no-brainer. It's something you must do. Right, can we move on a shade? Go on to page 11 of your notes. I have a confession to make. Me personally, I don't really get that involved, top of page 11, on R&D. But our team at Gravita do. I had a case the other day in London where I spoke to a delegate, and I said to the delegate, she came up to me at the end of the lecture, and she said, one of my clients is doing something, and I've told them they can't get R&D relief. And I said, what are they doing? And she described it. I said, well, I think they can. And I gave her my card, and I think she's going to contact us and we can help her. Do you know, there's over 400 people watching this webinar this morning. And I reckon there must be probably about 20 or 30 of you that have clients that are incurring research, doing expenditure, and you think, oh, we can't get R&D, but I bet you can. You need to speak with our team. We've got, I think, some of the country's top R&D people here, and we could help you. And we would be very interested in speaking to you. And you tell us the expenditure that the client's got, and we can tell you whether we think, and we can help you and assist you in making the huge R&D claim. Right, leave you to consider that. Now, number 5, incorporation. This is a problem area. And I do a lot on landlords. And landlords, their tax is complex as an individual, and it's very penal, very heavy. I mean, you know, every time an individual landlord sells a house or flat they've been renting, they've got to pay the capital gains tax within 60 days of completing the sale of the property and file the return. And a lot of individual landlords have tax that is very tough. So what a lot of landlords are thinking of doing at the moment is incorporating their rental property portfolio. This is on page 11 of the notes. But there's big tax traps. And the worst trap is stamp duty. You know, you can't just do this. You really do need to take tax advice about, is it worthwhile us incorporating our rental, or the client incorporating the rental property portfolio? We could help you with this, but I'll tell you what, we're going to be honest, and we're going to say to some clients, it's not worth you doing it. We can't really help you here. So you can't always incorporate, because what you've got to appreciate, you've got to route it probably through a partnership, and could be stamp duty problems that in some cases you'll be able to do it, but not all. And you do need to have a look at each individual circumstances prior to actually really doing the incorporation. The two main problem areas, I think, when a landlord is thinking of incorporating the rental property portfolio, which is probably worth doing, but to do it tax efficiently, you've got to overcome the stamp duty and the capital gains tax hurdles. Now, if I can move on to incorporating generally, look at your notes on the middle of page 11. A lot of accountants for clients forget landlords, just generally think, oh, we'll incorporate, and they miss a claim. You want to star your notes. When you incorporate a business, and the business might have been doing badly, and you might have got personal losses as a sole trader, and you're thinking of incorporating, well, you need to remember about Section 86 of the Income Taxes Act 2007, middle of page 11. And you've got to remember that if you incorporate your loss-making sole trader business, and you start to become profitable, Section 86 will allow you to set off the income tax losses that you've got unrelieved as a sole trader against your income from the company, any income, salary, dividends, even loan interest. A lot of accountants are not aware of the Section 86 claim, and they miss it. So if you're incorporating a client and the client's had bad times as a sole trader, last chance saloon, they want to incorporate, do things in a different way, you want to make a note of the losses that they've accumulated as a sole trader that they haven't been able to use, and then God willing it gets profitable, your income from the company can be covered by those losses. Read it in the notes. If you go to the internet, there's lots of articles on Section 86, and you want to warn your clients accordingly. Right, now, the next area, part 6, IHT. Now, probably on other webinars and other bulletins and reading stuff, you're all very aware that obviously there's huge changes on the horizon for inheritance tax. And if I can just look at the main ones, at the moment, business property relief, if you die with a business or you die with a farm, you've got unlimited BPR and APR. But big changes are afoot on the 6th of April 2026, and the combined maximum amount of BPR on the first 1 million will be 100%, and then below that 50%. So really, there is a lot of planning needed in relation to businesses and farms and farming businesses in the next year before this kicks in on the 6th of April 2026. And I would say that you could possibly consider getting the assets into a trust. And you might also consider family investment companies, and we could help you with that, because I think family investment companies are really a great planning tool. And they, for inheritance tax, for will planning in particular, for lifetime planning, they're very, very advantageous. time is against me here today, but you want to have a look at those. And our team could help you with that. We really could. Right, I'll leave you to consider all of that area. And likewise, if we move on to page 12, part 7, I've met quite a few businesses that are employee ownership trusts, and I'll give you the background. This guy, the last one that I met, this guy, he had a business and his kids weren't interested in it at all. They just didn't want to get involved. One was a solicitor and the other kid was doing something different. And he said, I'd like to sell my business to the workforce. And I met him ages ago and I said to him, well, get them to set up an employee ownership trust then. And he said, well, what's the advantages of that? And I said, well, if you sell your business to the employee ownership trust, there's no capital gains tax bill at all if it all meets the conditions. And he said, really? I said, yeah. And then I said to him, and they will love working through an employee ownership trust. They'll feel part of it. They can take bonuses out up to 3,600. Their whole working life will change, and it did. Now, time is against me today, but you do need to consider, particularly if you have got a client who wants to sell their business to the workforce, I think employee ownership trusts are a fantastic way of doing it. Right, part 8. Let's move on there. Part 8. Yeah, oh, by the way, just a quick, we're going on to the structures of bonus allowance, but just a quick word on cap allowances generally. I think with cap allowances, just an extra comment for owner-managed businesses. I think if you are looking at something and you're thinking, cool, is it plant? Does it qualify? And then you really research and you think, yeah, I think this is plant. I think we can get cap allowances. We should. We're correct. What you've got to do, I think, particularly if you have a meeting with HMRC or if you exchange correspondence, you've got to present your claim in an excellent way. And if you can give me 2 minutes just going outside of the notes for a moment, quite a few years ago now, we had a call, or I had a call, from an accountant who acted for a hotel, and they got a wedding license. And I went to see him, and I said, what are you going to do? And the owner of the hotel said, we're going to have weddings in the garden. He took me to the garden. The garden looked like a field. And I said, you're joking. They'll take one look at that. They'll never get married there. They'll run off. It'll cause a divorce. And he said, exactly. He said, we're going to landscape the gardens of the hotel. And he said, what's our tax position? And I said, well, HMRC feel that landscaping is capital expenditure that doesn't qualify for cap allowances. And they said, but we're going to incur a fortune. And I said, I know. And they said, can't we get the tax relief? And I said, let me have a look at it. So I went back to the office and I went through everything. And I thought, I think this does qualify as plant, as cap allowances. We made a claim and we argued that the landscaping was themed landscaping, functional, performing a role in the trade. And to cut a long story short, we actually got our cap allowances landscaping claim allowed and agreed. Now, I'm not going to guarantee in every case you can get it agreed, but in our particular case, they gave in and gave it to us. And I think that was really down to how we presented the claim. And you can do similar. If I can do it, you can. Right, moving on to page 12 at the bottom. The structures and buildings allowance is another form of cap allowances, but it's badly dealt with in practice. And all you need to remember is that if your client constructs a building, commercial building, any commercial building, a restaurant, a pub, a betting shop, an office, or structures, but it's mainly buildings, they get 3% straight line, which is dreadful. It should be 10%, but it's worth having. And I'll tell you one planning thing that you need to be really aware of with the structures and buildings allowance. You might construct a new office, and you might claim 3% straight line, 3%, or a hotel. And on the hotel, you claim it. And then a big chain comes to you and they say, you've done wonders with your hotel. We want to buy it. You've had the hotel for 3 years. You've only got really 9%. People email me and they say, well, what's the capital ounces position? If you go to your note and go over to page 13, the capital ounces position is that when you sell that hotel that you constructed, that you've had 3 years capital ounces on, the balance of the capital ounces goes to the purchaser automatically when you sell it, which is ridiculous. There's no balancing charge. And so you've constructed the hotel. You've only got 3%, 3%, 9%. And then the purchaser steps in and they get 91% of something they didn't construct. Do you know what I do and what you should consider doing? A lot of accountants don't do this, but what I do, and it's been successful, if my client is selling any commercial building at all, I always say to them, charge the purchaser in the contract, in the sale agreement, for the deferred taxed asset, for the 91% capital ounces they're going to get. And we started doing this ages ago. And the first time we did it, this solicitor for the other side, he went mad and he said, you can't do this. I said, I can. And if your side is not going to pay, you don't get the hotel. A lot of haggling. Eventually, they gave in because they really wanted the hotel. And they paid for the deferred tax asset, as they should do, for the capital ounces that they were inheriting. So that is something that you really need to consider. Perhaps you need advice on that, but it's doable. Sometimes you have to haggle a bit and horse trade, if you don't do it, I think there's a possibility you could get sued by your client because you haven't given them the advice that perhaps you should be giving. I don't know. Leave you to consider all of that. Right, now, I'm getting towards the end or near the end. Number 9, and I knew this would happen, benefits in kind needs another separate webinar, and we're holding it. And if you're not booked on, you should book on, because I'm presenting it, and I'm going to tell you on that day what are tax efficient benefits, what are not, what you can do, planning. So put in your diary, Thursday, 27th of March, 9 o'clock till 10, the Gravatar, and I'm doing it for us. We're having a big webinar on tax efficient benefits in kind and also pay as you earn and various other things. And it's well worth attending. Leave you to consider that. So we won't do that today. Right, the final things prior to me finishing. Salary sacrifice, part 10. You want to consider that. And I'll talk more about that when we do the March benefits in kind webinar. But if you're an employer and you have an employee who you rate really highly, and you say, Freddie, I'm going to offer you, this is the employer, you can drop your salary from 100 down to 95, but in return, we're going to give you the full private use of a beautiful, brand new, fully electric company car. And he says, well, give me all the maths, show how it works out. And you do, he'll do it. Because the tax and national insurance saving for everyone of doing a salary sacrifice and in return having a fully electric company car is phenomenal. And I've actually copied in the notes one of our clients on page 15, what they did and the salary sacrifice that they did. You can read through that on page 15 and it's phenomenal. And you really want to have a look at it. But I'm going to give you a word of warning here. In my opinion, you can only do the salary sacrifice and get the full tax benefits if the employee sacrifices their salary and does one of those 6 things on page 14, which are on the screen. So star your notes, unless you're really doing one of these 6 things. And I think the main ones are you drop your salary and you get in exchange a fully electric company car provided by the employer, or you drop your salary and the employer, this is the big other one, makes the difference, pays the difference into an approved pension scheme for you. If you do one of those 6 things, the tax saving is phenomenal. It's really worth doing. There were rumours that Rachel Reeves was going to outlaw this in the budget. It was in all the newspapers and it was in the tax magazine. She didn't. I hope that she doesn't outlaw it when she has her next statement or budget. But it's doable at the moment. And what you really want to do is to go to the notes on page 15 and work through the example I've given you, loosely based on one of our clients. They did a salary sacrifice. They got a fully electric company car in return, and they saved a fortune in income tax, national insurance, and the employer, and particularly with employers, NIC increasing to 15% in just over a month's time. Salary sacrifices, I think, for the right things are brilliant. Right, now page 16, if you go to point 11, bonus or dividend, getting the money out of your business, your company, what's better? Who can say? But things have changed. Dividends now are pretty expensive, the tax on dividends, because you've got a top rate of 39.35. And you've got to remember, dividends is paid out of taxed company profits already. And also the dividend allowance exemption was £5,000, then it went down to 2,000, then it went down to 1,000. And if you look on point 5 of page 16, it's currently £500. There's rumours that it's going to be scrapped completely. Can I give you my opinion? In a lot of cases that I've dealt with in the last year, and the client's got spare 60,000 in the company or whatever, when we've looked at it and thought, well, should you get the money out as a bonus? Should we get out a dividend? In a couple of cases, there wasn't much in it financially. Do you know what I think you should do? Can I try and help you here? You should acquire tax software to that will enable you to put the figures into the software, and then it produces the answer, what gives you the higher return. And we could help you perhaps, and we could point you in the right direction, but you could practically do it yourself. Just go on the internet and do a search for the appropriate software. That's what I think the good accountant should have to back him up or her up when you're looking at, we've got spare funds in the company, should we get the money out as a bonus or a dividend? Right, okay. Miraculously, I've reached number 12, and number 12 is tax investigations. If you go to page 17 and 18 of your notes. And here at Gravita, we specialize in investigations, and we've got a jewel in the crown. And that jewel in the crown is Dion Laycock. And I call him the bodyguard. And what do I mean by that? Well, he is the person you want to help you when you've got investigations. For example, there was one client, and HMRC were really saying and doing things that they shouldn't perhaps have done. And Dion, I think, is one of the country's top guys on investigations. And I reckon this morning, there must be quite a few of you watching this webinar who've got clients that have just started to be investigated or it's going through. Perhaps you need Dion's help with that area. And there's another area that I or Dion or our team could help you with, and that I've been involved in quite a while, for a long time now, years, alternative dispute resolution. If you look at your notes, it's something that I think a lot of accountants miss out on, but they should consider claiming and electing for and happening. I'll give you an example. A few years ago, a lady comes up to me at a lecture and she said, Mr. Palmer, I've got a big VAT dispute with HMRC. And I said, yes. And she said, I'm right. And I looked at it, I thought, yeah, you are right. I'm surprised that HMRC have not conceded this. And she said, I don't want to go to the tribunal. I don't want to go to court. It's going to take ages. And I said to her, well, why don't you apply for alternative dispute resolution? And she said, well, what's that? And I said, well, you go on the internet and we could help you with that. And you elect for the case to have alternative dispute resolution. And then an independent mediator will be appointed who's pretty fair, and then you go to a meeting with the mediator, with the revenue, and your firm with the client, and the mediate, and hopefully the mediator will get the revenue to C-cents and you win your case, and then everything's great. And she did. And it saved her thousands and thousands of VAT for the client. Dion could help you with that. Our team could help you with that. I think alternative dispute resolution is one of the best areas that initially you should apply for if you've got a dispute and you're not getting anywhere with the revenue. It's quick, it's cheap. Maybe your client's fee protection insurance policy will cover the cost of the alternative dispute resolution accountancy fees, probably. But anyway, that's something that you can have a look at in the future. Right, miraculously, I've come to just after 10 o'clock. I've covered the 12 things. That's it, but I just want to say a few more things, if I may. There is a lot of tax planning that I've given you this morning in my hour. I'm going to go and sit down and have a cup of tea now. But I've raised lots of areas. You need to, perhaps, if you're interested, come back to our team, and we'd be delighted to help you in some of the areas that I've raised. If you've got queries, we'd be delighted to help you. Now, as Mark said at the start, we do regularly put on lots of webinars that I think are very useful to the accountancy profession. Sometimes I find it hard to keep up with the webinars we're doing. I looked at our website, Gravita's website, yesterday, and I just noticed that on the 3rd of March, we got a webinar, Public Service Pensions, Urgent Tax and Pension Updates after the McLeod ruling. That's on Monday, the 3rd of March. I would have a look at that. If you go to our website, you can see all of the webinars that we're doing. On the 11th of March, I strongly recommend that you attend this one. Gravita is holding a webinar in respect of the FRS 102 changes, how you prepare your accounts under the new regime. I think that is not to be missed. And as I said, I'm coming back on Thursday, the 27th of March, on my benefits webinar, and I'll be joined by the bodyguard, by Dion Laycock, and he's going to talk about how Gravita and what we do on pay-as-you-earn health checks. So that's part of it as well. But that benefit in kind webinar, I'll be explaining what benefits I think are tax efficient, what benefits perhaps you haven't even thought of paying your staff or your clients paying their directors, what are efficient and what are not. And so I think that's one perhaps that you could find very useful and you want to sign up for. I'm going to finish on a slightly jovial note. Do you remember I told you that dentists were very important at the moment? And if you can give me 2 minutes just before I finish. And dental associates are being investigated, their status, etc., etc. I'm going to finish on a slightly light-hearted note. And I think everybody needs a bit of joviality at the early part of their day. But this is what happened to me. About 3 weeks ago, I started getting huge pains in my teeth. And I'm lecture all the time. And my wife, Barbara, she said to me, you've got to go and get this sorted out. I hate going to the dentist, but I went to see him. I don't like my dentist particularly anyway, very serious man. Anyway, I went to see him. We've never joked about anything. It's just very formal stuff. And he said to me, Mr. Palmer, you've got 2 teeth at the back. You need them taken out. And he said, are you available to come in here tomorrow afternoon to get them taken out? And I said, yes. And I said, I'm lecturing in the morning. I'm doing a webinar in the morning, but I'm free. He said, right, well, come in and see me at 3 o'clock tomorrow afternoon. I did. I go to the surgery. He injects me. And he said, you need to go back into the waiting room for 10 minutes, quarter of an hour, so that the anesthetic can really kick in. And I did. And I went back into his room to get the teeth taken out. And he said to me, so you're a Tottenham fan then, are you? I said, well, how do you know that? And he said, well, I've looked at your hoodie. It was a different hoodie I had on. And he said, I can see the cockerel emblem. I said, yes, I am. And my mouth is swollen up. And I said, who do you support? And he said, Arsenal. I thought, oh my gosh. And the nurse in there, and I saw actually her face sort of get worried. And he said, this won't hurt. And he's about to take 2 teeth out. The first teeth that he took out, tooth, cracked. Even with anesthetic, I've never been in so much pain in my life. I couldn't go home. My wife had to come to the surgery to drive me home. I had to leave my car there. And so it's not just tax that's very, very painful. Right, I'm going to finish there. Thank you so much for watching this morning. I look forward to seeing you again soon. Go to Gravita's website, keep in touch with us, and contact us if you need any help or assistance or consultancy with some of the things that I've said today. Enjoy the rest of your day. Bye-bye.